My name is Eli and I'm making this video to explain several actionable tips on how you can protect yourself from the next market crash financially and psychologically, and how to make lots of money coming out of it. These are things you can do both right after this video and for years to come. And instead of just telling you what to do as an investor, I'm going to explain why, so you can understand what's actually happening to your portfolio. Because if not, it's like you're a hockey player sliding around without skates. So let's get into it. And if you hear something that doesn't initially sound relevant to you, just trust me on this one. Try to stick with it. And before you ask, the reason I'm wearing a suit is to build credibility to sell you my online course. I'm just kidding. I don't have a scam course to sell you. This is just straight value, so like the video if you enjoy it. First and foremost, you need to internalize the idea that stocks represent ownership in an actual business. They're not just abstract charts floating around in an empty void. And I know you've heard this countless times, but stick with me because I'm going to show you what that actually means and how to apply the concept mathematically so you can distinguish between the stock price and true value of the stock. And no, I don't mean just looking at a PE or something like that. To understand this, you need to know that for the most part, the value of a business is based on its ability to generate future cash flows, its assets minus its liabilities, and assets technically includes intangibles like brand name, and your ability to sell that business to someone else in the future. Now, this last part can really trip people up because this can change wildly based on market conditions, but there's actually a really easy way to tackle this uncertainty by just assuming that the price someone is willing to pay is based on those first two fundamental factors, and I'm about to explain how to deal with those factors, but you should know that doing this makes it much more likely for you to resist acting on the greater fool theory, which is a common vortex that people get sucked into and is basically the idea that you can buy a stock at a fundamentally overvalued price just to sell it to someone else at an even higher price in the future, thus making that person the bigger fool. But just because someone is a bigger fool than you doesn't make you unfoolish. And there's mountains of data to support the fact that this strategy does not work over the long term, even if it happens to have worked for you all year. So now I'm going to get into using cash flows to value the business so you can actually have a number at which point you'll either buy or sell the stock, like $109. And I'm going to explain this as well as I can, but if you just don't want to sit through this section, skip to this timestamp so you won't miss out on tips that are highly relevant to you, whether you're an index fund investor or individual stock picker. But to be clear, you should seriously stick around for this, especially if you haven't learned this stuff, because no joke, this is probably going to be one of the best things you've learned in 5 minutes and could wind up making or saving you lots of money. And I don't take this lightly, I'm completely serious. The basics of valuation based on discounted cash flow analysis. Okay, if you really want me to do a more in-depth video on this, talking more specifically about the factors I'm discussing, let me know in the comment section below, but this is just going to be more of an overview. So remember, one of the key factors of determining a company's value is based on its ability to generate future cash flows. Now, what is a cash flow? Okay, so you know what revenue is. That's kind of like the net sales of a company. And then net income is all of the expenses they have subtracted from that revenue, and that's how you get net income. Now, the thing about net income is that accounting tricks can be played to adjust that, and other things are factored in that are not factored in into free cash flow. The two should both be analyzed, but for the purposes of this model, we're going to talk about analyzing free cash flow. Free cash flow is the total cash that the company receives from operations minus any capital expenditure, which is kind of like reinvestments into the business, and then the sum of that is the free cash flow. So in this case with Apple, you have $108 billion of operating cash flow minus the capital expenditure, and you get to $98 billion in free cash flow. Now that you know what free cash flow is, let's quickly model that. And keep in mind, this is the foundation for successful investing. I'm going to be taking PayPal as an example, and in the last 12 months, they did $6.6 billion of free cash flow roughly. Oh, and by the way, all these numbers are in thousands unless indicated. Okay, so that's year zero because that was the last 12 months. So now we have to figure out what are they going to do next year, and then this next year would be year one. Okay, so how do you go about predicting growth in future cash flows? Well, you can go about it in lots of different ways, but oftentimes it's really hard to say. So in many cases, it's good to stick to predictable companies and things that you feel more sure about predicting, and then you should err on the side of more conservative in these numbers. Now, PayPal currently processes around a quarter of total e-commerce, and the question we have to ask ourselves is total value of e-commerce going to increase or decrease in 10 years? Well, obviously it's going to increase, and the truth is competitors like Apple Pay are not going to render PayPal's business obsolete. Many of these competitors have been around for 10 to 15 years, and people are still going to use PayPal in 10 years. But for the purposes of this, I'm going to use very conservative numbers, assuming PayPal's business grows minimally or even flatlines when inflation is taken into account. Now, the company expects to grow 8 to 9% in free cash flow, up to maybe 20% in future years, but I'm going to actually actually just say 5% to make this argument even more compelling. So in Excel, I just took this number, added 5%, and that's going to be their expected cash flow for next year. I continue to do this for the next 10 years, and remember, this is probably unrealistically low, but we're just going to err on the side of caution. Okay, so someone might be quick to just add up the value of all those cash flows and say that that's the value of the company, but you can't do it that way because each dollar you're going to receive in year 10 is worth less than a dollar today. Why? Because the future is uncertain, and a loss of time over 10 years represents an opportunity cost. Therefore, we have to discount the value of those cash flows each year at a certain rate per year to make sure we're adjusting the value accordingly. Now, you're doing all this work, you might as well want to keep up with the market. So for this case, I just used a discount rate of 10%. Now, Excel has a function for just doing this for all the cash flows, but you should know what's actually happening, and it's basically just an exponential depreciation function. So what's happening is you're taking this number and then you're discounting it by 10% a year. So that would be dividing it by 1.1 to the power of 3 for 3 years. And then you would get this number. So if someone wrote an IOU today that says, I'll give you 7.6 billion in 3 years, that IOU would only be worth 5.7 billion today, assuming you want to make 10% per year. Now, I did this using the Excel function, and I get a total net present value of $51 billion for years 1 through 10. So this means that the total value of all the money that PayPal is going to make from next year to 10 years after is $51.5 billion. But wait, what's going to happen at year 10? Because the company isn't just going to disappear. If you don't know what's going to happen, couldn't you at least sell it to someone else at the end of that year? Yes, and that's where this factor comes in, and it's assuming that cash flows continue for the foreseeable future, albeit growing at a much lesser rate than before. So this is called the terminal value, and for trying to predict this, I use the Gordon growth model, the cash flow at year 10, assuming a 3.5% growth rate thereafter. But wait, the cash they produce in year 50 is going to be almost worthless to us compared to the cash they produce in year 11. And this is where this function comes in. There's different ways of doing it, but this is a very popular one. O3 is this terminal value, and it's discounted by the discount rate. So then you get to $66 billion, and that's going to be the value today of cash produced in the future. So now we're very close to the answer, so stick with me here. We add the total present value of years 1 through 10 and terminal value, and then you get the total value of all future cash flows. But there's one more thing we have to do, and remember I said you have to account for the company's assets minus liabilities, and people have different methods of integrating this into a discounted cash flow analysis. But for these purposes, I like to subtract their cash balance from their total debt amount, and this would give you their net debt. So in PayPal's case, they actually have a negative net debt, which means they have more cash than debt. And then you subtract the company's net debt from the value of future cash flows, and in this case, because it's positive, it's going to actually add value to our business. Finally, you get the total intrinsic value, and then you compare that to the market cap, which today is about $70 billion for PayPal. So in this case, based on these conservative calculations, this company looks pretty undervalued, and the stock price represents a 43% discount from how much the company is actually worth. And remember, this is discounted from the point at which you would already make 10% a year on those future cash flows. Remember, I didn't even talk about intangible assets like brand name, and if you want me to talk about more qualitative factors, leave a comment and I'll do an in-depth cash flow video in the future. But now you can distinguish the company from the stock price, allowing you to buy at good prices in stock market crashes and make a lot of money coming out of them. Like this video if you think that was cool. So using this valuation method, you can determine what a stock is actually worth and disregard all the other nonsense, protecting you from market downturns so long as you don't need the money right away. And that leads nicely to my next tip, which is to simply stop investing if you are trying to use it as a means to pay off credit card debt. These valuation methods are based on long-term business ownership, and in the short term, the markets can stay irrational longer than you can stay solvent. And with many cards charging between 20 and 30%, the chance of you consistently outpacing this number are effectively zero. So you should probably start by paying that off first. And if you can make me 30% per year over a long period of time, leave a comment because I'll give you $1 billion in 50 years. And Goldman Sachs will probably give you $1 trillion. But even with this valuation method, the fundamental analysis must be paired with the following tip, which if you can master will set you ahead of countless investors, because failing to do so is actually one of the biggest causes of capital loss. The tip is to conquer the psychology of the market. And to help you with this, I have something to let you in on. This idea was first credited to author and investor Ben Graham, and it's the idea of Mr. Market. For your purposes, as an individual investor, the stock market can be thought of as an obliging business partner who comes knocking at your door every single day with a number. The number is the price at which Mr. Market is willing to either buy your shares or sell you his shares. The beauty of this is that if you don't like what he has to say, you can just ignore him. He's here to serve you, not instruct you. And with your fundamental valuations in mind, it helps if he's a manic and emotional alcoholic. Some days he's reasonable and some days he's wildly irrational. But if you're not careful, Mr. or Mrs. Market can be like a toxic partner who bombards you with psychological mind games until you are financially ruined. So my next tip is to help you with this, and that is to uninstall Robinhood. But before you click off yet, I know what you're thinking. Yada yada, I've heard this before, but to explain this, I have one question for you. Have you ever used Instagram? If you have, you'll know that after you open the app, in no time you've spent longer than you wanted to. Why? Because the app is meticulously designed to keep you on it for as long as possible so it can show you more ads. Okay, but how does this apply to Robinhood and the stock market? Correction, Robinhood and Mr. Market. Well, Robinhood actually works in a shockingly similar way. The only difference is that instead of selling you ads, it charges you trading fees. So the app is designed to extract the most amount of trading fees possible by keeping you on the app and priming you to trade more often. Now you might be saying that you don't fall victim to these psychological mind games, but I say, who cares? It doesn't even matter because it's not worth the risk. The truth is you don't know how much these things are affecting your decisions, but I can tell you if you feel the urge to check your app more than once a day, they're probably affecting you in one way or another. Multiply that effect by the fact that the stock market already presents psychological games and you'll realize it's just not worth it. Therefore, my suggestion is to simply uninstall all of your investing apps and just use your phone's stock tracker app to keep up to date. Then, if Mr. Market is acting particularly irrational, reinstall your app, do what you have to do, and then uninstall it again. Because remember, those numbers alone don't tell you what your shares are actually worth, just what Mr. Market thinks. And most of the time, it's best to just shut your window, lock your door, and check back another day. So hopefully, as a result of this video, you're going to be better prepared to tackle the next market crash whenever that may come and to make money coming out of it because your cash flow analysis can tell you what prices are screaming deals. Thank you for watching. If you found value in this video, leave a like and subscribe because this channel is dedicating to creating value by showing you how to master your mind and matter. So tune back in for my next video and have a great day.